I'm so glad that so many people could join us for this virtual conference today, a day when some of the questions we're discussing here are really so much in the news. I'm going to start with the usual Federal Reserve caveat that the views I express over the course of this panel discussion will be my own and not necessarily those of the Federal Reserve. And I hope to embody some of the frankness that my colleague Art Lindo showed in his chat with the Dean in our first session. We're currently in an FOMC blackout period. I'm not going to be speaking about current or prospective monetary policy issues, but what we will be talking about here are the questions relating to cyber risk and financial stability. I think these questions are going to be at the heart of our mission to achieve economic growth and the Federal Reserve's role in ensuring safety and soundness in the US banking system. Over the course of this panel, we're going to be talking about what we've been learning, hearing from a panel of experts who have each been writing about these questions from a variety of different perspectives. Our panel is going to begin with about 10 minutes of remarks by each speaker and then proceed to more informal discussion. I'm going to introduce each speaker, which serves as an opportunity for them to begin projecting their slides to the extent that they have some. After the presentations, then we'll have a Q&A session. First, we're going to hear from Leonardo Gambacorta, who is head of the Innovation and Digital Economy Unit at the Bank for International Settlements. Leonardo, I'll hand it over to you, and you have about 10 minutes. I won't give you a warning, but I'll try to signal once your 10 minutes have elapsed. Thank you.
Thank you very much, Anna, for the introduction. Are you able to see my slides?
Yes, I am. Thank you.
So let me just maximize the... Okay. So it's a great pleasure for me to be here and take part to this international webinar on the implication of cyber risk to financial stability. Thank you, Anna, for the introduction and for inviting me to be part of this panel. My contribution to the panel today is on COVID-19 and cyber risk in the financial sector. I will start with some facts and consideration on cyber risk with a focus on the financial sector. I will then move to the effects of COVID-19 pandemic and working from home on cyber risk. And at the end, I will conclude presenting you the main takeaways of this talk and some policy consideration. And as you already said, the usual disclaimer applies. So let me kick off this discussion on what we are learning on cyber risk with the one very simple consideration. So cyber risk is receiving a growing attention, and it is today on par with the concept of operational risk. So this slide has been constructed using Google Trends and reports the number of online searches for cyber risk over the last decade, and compares it with the term operational risk. Despite the fact that cyber risk is only a subset of a firm's operational risk, you can see that worldwide the search interest for the two terms is today almost on par. So we observe a lot of attention on cyber risk, but little is known about cyber risk drivers, the cost, and mitigating factors. So in a recent study conducted here at the BIS in collaboration with the FinTech Lab of Pavia University, we have investigated the drivers of cyber costs across sectors using a unique data set from Advisor of over 100,000 cyber incidents. So if you look at the left-hand panel of this slide, cyber incidents are more frequent in the financial sector. So a quarter of all cyber incidents affected the finance and the insurance sector. This is represented in the first two columns. In red, you have the gross loss. In blue, the frequency of the cyber incidents. In the center panel, you can see that while the numbers are higher, the corresponding gross losses are not necessarily larger in the financial sector. Fraud, notably in the form of privacy violation and phishing skimming scams, is most frequent but least costly. Data breaches are both relatively frequent and costly, while business disruptions are quite infrequent, but can have very, very high cost. So the study has also several other findings. The results are summarized in the right-hand panel. So the cost of cyber incidents is generally larger for bigger firms, but this effect is smaller for the financial sector. You can see the first two columns here in the right-hand panel that indicate the relationship between cyber cost and firm size. And as we know, cyber incidents can be interconnected. For example, a single incident can hit several organizations at the same time. So while the study shows that the higher this connectivity, the higher the cost, especially for financial firms. You can see this from the third and fourth column in this last panel. And one last consideration that I want to do is on cloud technology. So cloud technology can reduce IT costs, improve resilience, enable firms to scale better. So here, in the last two columns in the right-hand panel, we have multiplied the effect by -1 for comparability. And however, the use of cloud services is associated with lower costs only for minor cyber incidents. When the cyber incidents are large, there is no visible effect, and moreover, this effect is significantly smaller for the financial sector. As cloud use increases and cloud providers become systemically important, cloud dependence is likely to increase tail risk. But is it possible to calculate cyber risk more precisely? So we know that cyber and IT-related risk are a subset of operational risk. In another research conducted here at the BIS, we have investigated operational and cyber risk using a unique cross-country dataset from ORX on over 700,000 operational loss events for 74 large banks across the globe. As you can see from the left-hand panel in this slide, cyber losses represent a very small share of banks' overall operational losses, is around 0.4%. One way to assess potential losses from cyber incidents is by estimating the value at risk measure. So the value at risk measure indicates the level of risk to which a firm, a portfolio, or a single position may be exposed over a given time period. From the right-hand panel, estimates suggest that the operational value at risk range from 6 to 12% of income, depending on the method used, and the cyber VAR in turn can range from 0.2 to 4.2% of income. These amounts correspond to around 1/3 of operational VAR. So cyber VAR could indeed be relatively high because although cyber risk incidents are relatively far less frequent and on average less costly, they could in extreme cases be particularly damaging. Let me conclude with a couple of slides on how cyber risk has evolved during the COVID-19 pandemic for the financial sector. So in general, we can say that the financial sector has been hit relatively more by cyber attacks than most other sectors since the pandemic started. And on the left-hand side of this slide, we compare the frequency of cyber events by industry in the period of March to June 2020 with an index of working from home arrangements by the industry. So as you can see, there is a strong correlation between the prevalence of working from home arrangement and the incidence of cyber attacks between the end of February and June 2020. And the financial sector, that is represented by this red square, ranks high on both accounts. So if you move your attention to the pie on the right, the financial sector, finance and insurance, has the largest share of cyber events classified as COVID-19 related in recent months. So with this slide, I would like to stress the fact that working from home opens up new possibilities for cyber attacks. I think that this is an important point as many firms will increase their working from home arrangement in the post-pandemic, and all of us will probably spend more time working remotely. So these two panels show the results of a survey among financial institutions by the Financial Services Information Sharing and Analysis Center, the FSISAC. So this survey finds a substantial rise in phishing, suspicious scanning, and malicious activity against web pages for working from home staff to access the network. On the left-hand panel, when we look inside the financial sector, we discovered that during the COVID-19 pandemic, payment firms, insurers, and credit unions have been especially affected by cyber attack. You can see this from the 3 dots on top of the chart. And on the right-hand panel, the survey highlighted that in 45% of the cases, staff working from home overwhelmed virtual desktop infrastructure and VPN processes. And as you can see, in 1/3 of the cases, business continuity IT plans were not prepared for a long-term at-home workforce. Moreover, 1/5 of the financial firms reported that their network operation activities were interrupted during the pandemic. So let me conclude with the main takeaways of my short talk. So first, we have seen that the cyber risk is growing and is today a relevant component of operational risk. Second, during the COVID-19 pandemic, in the new working from home environment, the financial sector has been hit more by cyber attacks than other sectors. Third, while this has not yet led to significant disruption or a systemic impact, there are substantial risks from cyber attacks for financial institutions, their staff and their customers going forward. So let me finish with the policy consideration that financial authorities need working more to mitigate cyber risk, including through international cooperation. And at the end of the story, cyber resilience is a global public good. So thank you for your attention. I pass now the baton to Anna, or to my colleague, who is next in line.
Thank you very much for that informative presentation. Our next speaker is my colleague, Michael Lee, who's going to talk about some of the work we've done thinking about these questions. He's an economist at the New York Fed in our research group. Michael.
All right, well, it's a pleasure being a part of this panel. The views expressed here are mine and not necessarily that of the New York Fed or the Federal Reserve System. So, as kind of indicated, cyber risk has become an increasingly important factor of systemic risk. And I want to mention kind of some broad trends and the confluence of these trends that kind of make this point very salient. So first of all, we have had an increasing reliance on the digital infrastructure. And just from the previous presentation, we can see that COVID-19 has only increased this further and accelerated this pace. Second, we see that increasing attacks driven by non-monetary motives, and that also, we just had an example just a few days ago, and this kind of highlights the kind of more complexities that are arising as we see a variety of different types of objectives of attackers. And finally, with this, we're seeing increasing sophistication of cyber attacks, and this comes as we are entering a sort of cyber arms race between security and attackers. And this brings us to a kind of a natural question of what are the repercussions if defenses fail? And so today I'm going to talk about work with colleagues at the New York Fed thinking about this particular question. And so in particular, we want to assess the cyber risk in the financial system using what we call a pre-mortem approach. And what we mean by this is the starting point is to assume that there has been a successful cyber attack on some key financial institutions, and then to use that to analyze the network impact using scenarios based on the wholesale payment system. Now, from a big picture perspective, there are kind of two questions that we have in mind here. So the first question is, how might cyber risk be amplified or propagated throughout the system? And secondly, what are the systemic features that are specific to cyber risk? So today's talk, I'm going to present to you some work based on a main scenario, which is a cyber attack on one of the 5 most active US banks in the wholesale payment system. Now, there are going to be 3 takeaways that I'd like to emphasize in my time. So first of all, the cyber risk is amplified by the concentration and velocity of financial activity. I'm going to show you some evidence of how that affects the propensity for a cyber attack to have a big effect, and also what we might expect in terms of the spillovers. Second, when we consider the variety of different attackers' intent with the information that the attacker might have, this can bring rise to a tail risk property of cyber risk. And this points to how cyber risk may have systemic consequences. Finally, I want to highlight the potential for correlated vulnerabilities. And in particular, these vulnerabilities that arise through the underlying latent technological network is hidden. And this kind of points to a big question for further research and work. So let me start with the first takeaway regarding the concentration of the financial system. So here's a picture that shows you the amount of payments in the wholesale payment system that the top 5 institutions collectively are responsible for. And pre, during, and post financial crisis, we see a remarkably stable fraction of payments. About 50% of payments are done by just 5 institutions out of over 5,000 institutions that are part of the network. This kind of tells you kind of a sense of how concentrated activity is among these very large institutions. Now, this translates into a sizable impact in terms of the repercussions to the entire financial network when a successful attack has occurred on any of the top 5 institutions. So based on our scenarios, we find that in terms of the sheer number of institutions, within a single day, 5 to 10% of institutions experience a liquidity impairment on average as a result of a cyber attack. But when we weight this by size, we see that the impact increases about 4-fold, reaching anywhere between 22 to 55% of assets across any of the top 5 institutions. And this indicates that because of the concentration of the financial sector, we will see that an attack has a broader consequence in terms of the day-to-day liquidity conditions of other institutions that are otherwise not affected. Now, a different dimension is to consider how this affects the actual operations of these institutions. And one response that we might expect from other institutions are to halt their operations in order to shore up liquidity. Now, if other institutions start to hoard liquidity, what happens is they're effectively foregoing payment activity, and this payment activity plays a vital function for the financial market and the broader economy. Now, based on our calculations, we find that there are significant disruptions. So the total foregone amount of transactions reach anywhere between 1 to 11 times daily GDP. And this just shows you the amount of payments that are being processed by institutions collectively in a given day, and also the potential for these payments to not happen, which would have huge spillovers to general activity. Now, in terms of the nature of these payments, we find that they represent financial payment activity. And this indicates that there are going to be potential big spillovers to financial market activity more broadly. Now, the second takeaway is to think about the strategic dimension of cyber risk. Going back to the analysis of our scenario, if you take a look at this distribution of network impact across days, there's a pretty substantial variation across days. In particular, the average impact across the top 5s at any given day ranges between 20% to 50%. And this shows that depending on the day of an attack, the precise day, the network impact varies quite heavily. And this brings me to kind of a defining feature of cyber risk, which is what is the attacker's underlying objective? Now, historically, we've seen a lot of monetarily motivated attacks, but more recently, attacks have been garnered towards achieving different objectives. And in particular, from a financial stability standpoint, it's cause of concern when the objective is to cause maximum damage. Now, when we consider this particular objective, the ability for an attacker to successfully achieve a large impact depends on what information the attacker has. And this information can include information about the target institution and also the payment system as a whole. Now, what we find is that depending on the amount of information, the impact of an attack will vary quite heavily. And we see that there's significant increases in impact as we gradually increase the amount of information and the nature of information that the attacker has, anywhere between 11% increase to up to 63% increases on average. And this indicates that with considering the underlying intent and the information that the attacker has, cyber risk can exhibit this tail risk property, where the attacker can reach the right end of that distribution in terms of network impact. Now, the final note I'd like to end with is this correlated vulnerabilities within in the context of cyber risk. So one issue is that we have technological commonalities across financial institutions, and this can link banks that are otherwise unrelated. Now, what this means is that when you have multiple institutions that are commonly sharing some particular technology, and this technology has some vulnerabilities, this can magnify the impact of a cyber attack through a simultaneous shock throughout the network. Just to give you an example, what we do is study a particular scenario that involves a set of institutions that are medium and large sized. And assuming that a failure of a critical service provider leads to the impairment of multiple institutions, we find that the impact in terms of network impact reaches over 60%. And this indicates that when we consider the potential for third parties to fail, the impact is magnitude even above and beyond what we would see from any of the single top 5 institutions. Now, this also points to an important kind of question for further research and work. We need to have a richer data on these technological commonalities in order to appreciate and reveal these hidden risks. And I think this will be an increasingly important issue that we need to tackle collectively. Thanks. This is it for me, and I'll give it back to you.
Thanks, Michael. While Leonardo and Michael had approached these topics from a banking and financial expertise, the next 2 panelists have been thinking more broadly about cyber risk and related questions. Our next panelist, Leroy Terlong, is an assistant vice president in the cyber risk group, where he works collaboratively with analysts across different lines of business, publishing research on cyber risk and its impact on financial performance.
Thank you. It's a pleasure to be here today. I'm here to talk about Moody's view on cyber risk to financial stability. As a credit rating agency, our view into systemic cyber risk is primarily looking at the impact on credit ratings. And that manifests itself through 2 main vehicles. The first is through sovereign credit ratings, and the second is through the individual issuer debt issuers' credit ratings. So on the first point, we put out a report in November of 2019, where we described Moody's house view on cyber risk as it relates to sovereign credit ratings. And you can see cyber is a very all-encompassing phenomenon, so it touches on a number of the different methodology factor scores that we have that go into the ratings for sovereigns. But I'll draw your attention to the first line, where we talk about economic strength and how an attack on critical infrastructure could disrupt economic activity. Here we're speaking more broadly about any of the 16 critical infrastructures that have been so designated by the U.S. Department of Homeland Security. And of course, the financial sector is one of those critical sectors. And the idea is that if one of these critical infrastructures is impacted, then economic growth could slow. And as an illustration of that, this infographic from the Bank of England shows you'd have some sort of shock, cyber attack that impacts one of these critical infrastructures, in this case, the financial sector. And depending on the length of the duration, its intensity, and the interconnectedness of that system, those are the main factors that would help determine if there would be some credit rating result coming from that. Typically, having some interaction with the consumer confidence falling, and then an impact being felt on the real economy. Typically, this would have to be of a large magnitude to impact the credit ratings of the sovereigns that we rate, but this is sort of the mechanism of how that would happen. The second would be through the individual issuers that are part of the country where that incident took place, or who were part of the ecosystem where that incident took place. So you can imagine in our case, speaking about the financial system, the banks, the payment systems, all of the many of those have their own individual ratings. And if there was some type of systemic attack that affected one or more of those organizations, depending on the severity of that attack, it could affect their credit worthiness, and that's something that we would be very interested in as well. Now, in an attempt to figure out what that risk would look like for these different entities, Moody's actually stood up our cyber risk group about 2 years ago now, and we've been working hand in hand with the credit analysts across Moody's to help them understand what the risks are from these different types of cyber incidents. And as many of you who work in cyber risk can commiserate on the there's often a lack of information that you can use to help inform your decision making and to help analysts understand how they should be thinking about these types of risk as it relates to their issuers. And so what we have done is we have come up with a survey that we are sending globally to all of the issuers that we rate to help our analysts understand, raise their expertise so they know the right questions to ask their issuers and also how to interpret the responses they get back from issuers. The responses that we get back from our issuers, we anonymize and aggregate the results, and then we publish them so that investors can have a better sense of what the cybersecurity practices are, what sort of differences exist between sectors, and also between things like regions and different classes within the sectors that we rate. And because this is an integral part of our analytical process, as part of the survey, we've had to, issuers are not used to getting questions from credit rating agencies on their cybersecurity practices. And so we've got some questions initially, is this, how is this going to affect my rating? Or is this just sort of like a research project? And we want to make sure that the issuers know that this is part of the analytical process. Cyber risk is a growing risk that's affecting all asset classes, all different types of issuers. And so this is not just a fishing expedition. This is related to the ratings that we're giving to the entities that's part of our portfolio. So this is an evolution of the research process that we've had. In February of 2019, we put out a heat map where we looked at the inherent cyber risk exposure of 35 broad sectors of debt that we rated Moody's. The sort of highest risk category were healthcare and financial institutions. In that initial look, we did not take into account the mitigations that different sectors have in place. So for example, financial sector is one of the best prepared sectors, but that was not incorporated into that research we put out. So in this new survey-based research, we're asking issuers to talk about their cyber risk governance, cyber risk management, and cyber risk transfer. And that helps us to better gauge what the measures that they are able to put in place to protect themselves are. So just giving you a look into what the results that come back from this survey look like. So the original cohort that we have published on is from the global electric utilities. Next will be North American banks in the end of January. And then we'll be going also through asset managers, global banks, and large global investment banks as well as payment processors. And so in this original cohort, you can see that there was a large level of participation from utilities in the US, then EMEA, and then in Asia, we only had 7 issuers respond. So that information was useful on sort of an individual basis, understanding what those issuers are doing for cybersecurity, but we did not include that as part of our results because we didn't think it was representative enough, and also we want to make sure that we're maintaining the anonymity of the information that our issuers are providing us. We grouped the survey cohort by size, and so you can see here we did it by total number of the assets. And so we had small, medium, large, and very large. We also looked at it by rating class as well as by sector. And some of the results that we got back, size was one of the biggest determinants, which kind of makes sense. They have more resources. They also have more to protect. And so you can see that in terms of expertise, the very large utilities had more people on their boards that had some cyber expertise. They also reported more directly to the C-suite. They had completed tabletop simulations or more sophisticated cybersecurity testing, including red team testing. They also were more likely to have things like explicit cybersecurity coverage through a standalone insurance policy. We also saw that state-owned utilities, their preparedness lagged that of privately owned counterparts. So you can see on this graph that in almost all of these categories that we looked at, the privately owned utilities were ahead of state-owned utilities in things like tabletop simulations, red team testing, and a process to remediate issues that might be found in penetration tests or in red team testing. You can also see here a large discrepancy between privately owned and state-owned in things like cyber insurance. And then lastly, rating levels and regional differences did not really have a major distinguishing effect in the cyber preparedness that we looked at. In fact, you can see here that speculative grade companies were, they had more directors on their board that had some level of cyber expertise, which seemed a little bit counterintuitive. Although you do see over here that investment grade companies were much more likely than speculative grade companies to have standalone cyber insurance. So the idea from this survey is to give us a better data set, better information to help investors understand how they should be thinking about cyber risk. It also can shed some light on who is better prepared to deal with systemic risks when they arise. It's important to note that we're not saying any sector or any type of issuer has good or bad cybersecurity. We're making comparisons among different groups that we're looking at, but it can give some insight into which types of organizations are better prepared to deal with these types of cyber risk. And lastly, I'll say that our goal as a ratings agency is not to make any sort of recommendations, is not to force any type of change. But under our Chatham's rules here, I'll say that we have been approached by a number of different entities who are very interested in what we're doing in cyber because they see this as an extra incentive for organizations to take cybersecurity seriously. If they know that there's going to be some sort of potential impact on their credit rating scores, increase in cost of capital, that this might be an extra motivation for them to take cybersecurity more seriously. And so we've gotten a lot of great coordination and cooperation with cybersecurity experts, with other folks who are helping us in this endeavor because they see the value of encouraging people to have more robust cybersecurity measures. And with that, I'll pass it back over to Anna. Thank you.
Great, thank you so much, Leroy. Our final speaker is going to be Jonathan Welburn, who's a RAND researcher in the fields of operations research and computational economics, who teaches at the Party RAND Graduate School. I'll hand it over to you now, Jonathan.
All right, thanks, Emma. All right, I should be sharing now. Yes, so yeah, I'm excited that you all could, that we're having this meeting today, and thank you for letting me join. And happy to provide a brief overview of some of the work that I've been doing at RAND with with some colleagues. And some of the work that I've been doing has been on the topic of systemic risks, cyber risks, and systemic cyber risks, and as well as cyber deterrence. And so happy to talk about that work today that is at that intersection of systemic and cyber risks. And was also excited to hear Arthur earlier talking about deterrence, because I think there's a lot of value there. But I thought I'd start this session with a quote from Thomas Schelling. Actually, so Thomas Schelling said that there is a tendency in our planning to confuse the unfamiliar with the improbable. That we have not considered what looks strange. What looks strange might be thought improbable. What is improbable need not be considered seriously. He warned that the danger is not that we should read the signals and the indicators with too little skill, but the danger is in the poverty of expectations, an obsession with a few dangers that might be more familiar than likely. And such is the story of systemic risks, and a really good motivator for why we've all come together to talk about systemic risks coming from an unconventional place. We've used the familiar story of past economic crises to drive a lot of research, analysis, and policy on the topic of financial stability. So after past financial crises, a lot of our focus has been centered around systemically important financial institutions that had become too big to fail, and how surprise shocks in these institutions could quickly ripple out across heavily interconnected financial networks, and how we could address the concerns of systemic risk to promote financial stability. So along with some of my colleagues at RAND, I've been really interested in this topic. And looking at looking at systemic risk beyond financial networks and beyond this poverty of expectations. So while many of studies of systemic risk have kind of focused on interbank networks or perhaps economic sectors, the concerns over the potential economic consequences have really driven us to look in a kind of different approach. And so I'm foreshadowing a little bit of that with this slide in the background, in looking at broader economic networks. So part of this is that in this area, data challenges are really significant. And I think the past speakers have done a good job of talking about various ways to address that. And here, in what I will describe, we've kind of taken another. So we've really looked at structural models that might help us estimate how connections in the economy can actually lead to cyber risk to really spread quickly. And we've done this in a few different approaches, and I will spare you all the the academic details of how we've gone through this, although I'm sure some of you are quite excited to hear that type of thing. But just to give you kind of a brief overview of what the analysis looks like when we do this. So I wanted to start by actually just talking a bit about systemic cyber risk also, and how we've already started seeing enough incidents to give us real reason for concern, enough incidents that you all, some of these incidents, I'm sure many of you are familiar with. So one was 2016, the cyber attack on Dyn, which was hardly a household name, really in the background of the internet, but a significant distributed denial of service DDoS attack against Dyn, which is a major domain name service provider, brought down a huge swath of the internet for a few hours. There's Amazon, Twitter, Spotify, there was media companies, there was government, all that were directly affected by this Dyn attack. Then there was the WannaCry and NotPetya attacks, which were global malware incidents that quickly spread around the world and affected a diverse sectors, healthcare, education, that were all sort of significantly affected. Individual companies like Maersk had lost 300 million, I think it was 300 million for Maersk alone in those incidents. And so those were one type of large economic consequence. And another would have been another good example is the attacks on power grids, and how the again, in 2016, Russia had launched an attack successfully, taking down a part of the Ukrainian power grid. But that's definitely not the end of that story. And we've seen more recent discussion over the past couple of years of Russians' intrusion into the US power grid. And so that is a real form of which adversaries are able to hold assets at risk. And we can use these examples to really talk about the ways that systemic cyber risk actually occurs. There is the cascading form of systemic cyber risk. And this is essentially the domino effect that happens across a heavily interconnected network, either that be through business networks, through supply chains, or through digital networks and computer networks, that you have this form of cascading risks. And Dyn is obviously a very good example of that happening in the past. And then there are the common cause systemic cyber risks, which would be and I think Michael's actually talking about this a little bit, right? That you can have a common or hardware vulnerability, which many firms share all at the same time, and that can be exploited all kind of simultaneously. And one analogy that I like to think about in this domain is that in comparison to sort of traditional risk management, where you might think about things with their co-located risk, that you're concerned about houses which are all in the same floodplain. That in cyberspace, that's kind of a different concept. You have more of a digital floodplain, right? Where if all of these assets have the same running the same software at the same time, or a lot of different companies are, that they're really kind of exposed in almost a co-located way. Of course, there can be there's the cascading risk, there's the common cause, there could be independent, of which case a lot of firms are suffering a cyber attack all at the same time, but that's kind of a less likely scenario. And with these two types, we have really focused a lot on the cascading cyber risks. I think that the common cause is something where there's a reason for a lot more attention moving forward and a lot more sort of data gathering that helps support that type of analysis. But as we have looked at the cascading, we've taken a couple of different approaches to do that. And I just want to summarize how we've done that. And one of those was really to look at the importance of firm level networks. And this is the graphic I had on the first page, but to kind of explain that a little bit, we've gone through approaches, as have others, of really trying to understand the interconnections of individual firms throughout the U.S. economy. And in this network graphic is one of those pictures where all the little dots represent companies across the economy, and the connections represent the linkages and the flows of goods and services across those, which we've estimated. So just to kind of explain this for those who aren't familiar with this type of approach, essentially what we have done is that we've looked at this, all of these interconnections in the economy, and we've said, well, what happens if there is a sudden surprise attack on a given node or given company and in this network? And what then happens is that as that company suffers an outage, that the loss would then ripple upwards, and it would ripple upwards through sort of upstream in their networks, and their suppliers and suppliers and so on would suffer economic damage as a result of this. And then as well, after that single disruption, there would be losses that ripple downstream in their networks as well to their customers and customers and so on. And the network approach really helps us do that. One thing that's really interesting about this, just as far as the economics of it go, is a lot of the losses that happen after one of these attacks in our modeling, and as well as some others, really come from the downstream side of this. And I'm just going to show you kind of what the results are. So we went through this, and we've done various different approaches to look at what the impact would be of an outage that leads to a 1% loss in revenue for different companies, and to really look at what the aggregate damage would be. And when we did those and took the top 1,000 and ranked them, our results essentially look like this. So these are the top 20 of that top 1,000. And what you have is a very, it's somewhat of a surprising picture, at least for me, because when you look at the essentially systemic risk that happens across many different sectors of the economy, you have a list of companies which is very diverse. You have General Dynamics on this list, Boeing, Anthem. At the very top, you have the Walmarts, you have Comcast, Amazon. That might not be totally surprising because they're very large companies, but I think it does kind of run counter to the traditional narrative on systemic risks. And part of this is the fact that when you actually look at risks like cyber, which are able to quickly spread across these companies' networks, that you do have some companies really looking towards the top of this list, like Amazon or Comcast, which are extremely heavily interconnected in our economy, as well as the AT&Ts of this world, the IBMs, where they're providing digital services which really provide the kind of backbone of our economy. And the other thing that can happen is that, so this is a list as far as the total aggregate damage, but you can have a similar picture that I could make if I normalize this by firm revenue, because a lot of these are just big. And what, at the very top of that list by a lot is GoDaddy, which might not be totally surprising to those who are familiar with them beyond their Super Bowl commercials, but the fact that they are a sort of a major part of the internet. There's other companies on there like Workday who play a really large role as well, who are actually small companies, but have a large impact due to digital services. And the other
I'm going to give you the 10-minute wrap up.
Oh yeah, okay, thanks. The other thing that I was going to say is that the pandemic's really driven a rapid transition that I think a lot of us are familiar with, which is the fact that we have a rapid economic transition as we've gone from sort of Zoom, all of us using, to going in and out of the day using DoorDash, using Slack, maybe using Disney Plus, and all these are kind of services which hardly existed, didn't really exist a couple of years ago. And all of them are also hosted on Amazon. So we have a lot of new digital services who are playing a very large role in our economy, kind of elevating this risk and concern over cyber risks, but also the similar players like Amazon and Amazon Web Services, which really play a significant role in our economy and are highly at risk of cyber attacks. So I kind of just wanted to leave you all with that. And as a story of how we should be looking at systemic cyber risks in new places that are not just the traditional sources of systemically important firms. And here's a couple of our papers that we've done that are related. Thanks.
Thank you very much for that, and to all of our panelists for their insights in this. We can have you drop the screen share and have the panelists on. I'll take the moderator's privilege and maybe start with a question or two. And folks who are listening online, if you want to add your questions into the Q&A box, we can hopefully get to some of those in the next half an hour. One of the things I was struck by, in part by the reminder of the Chatham House rules in the slide, is this question about how we can balance the importance of sharing and discussing what we're learning with concerns about increasing these vulnerabilities by sharing this information publicly. And you can kind of see that also for those who are working, with confidential data like that at the BIS and then the Federal Reserve System, or even the types of surveys that that Moody's has been doing. How do you think about balancing the importance of information sharing about these risks publicly and privately, and what's the right balance here? You can each go one by one, or Michael, you've gone off mute if you want to start.
Sure, yeah, I can start off the conversation. I think an interesting point that you kind of might gather just from all of the very different presentations is the amount of creativity involved in order to learn something about cyber risk. And this points to the fact that we currently don't have enough information or data. And this information sharing is vital to enhancing the cyber resiliency, not just for individual institutions, but strengthening the system as a whole. And so I think before we even think about what are the vulnerabilities that arise due to it, I think the first question is, okay, well, we need to have a better understanding of these shared vulnerabilities. And it's however, as much as it is valuable for us to appreciate these kind of latent technological linkages, for example, this is also invaluable information for a cyber attacker with malicious intent. And it kind of points to the need for a robust and secure communication channel that we can establish between industry and policymakers, and a deliberate design where we consider how we can have essential information be shared without the concern that this, if shared publicly, can result in kind of broader consequences. So I'll stop there and jump in later on.
Leonardo?
Yes, the balance is very difficult. I mean, from a central bank point of view, obviously the use of big data in central banks creates both opportunities and challenges. As one of the most important challenges is, of course, cyber risk. So, but here I would like just to do a couple of considerations. That the first one is that while in the past most data were collected and hosted within a public institution, and hence they were readily available for the analysis with clearly defined access right. Today, so the data creation is as mostly migrated to the private sector. So private companies own vast troves of granular data, and some of which are not confidential and are not accessible to the central bank, while others are publicly available. Data are first consideration are not located always in the same place, and loss of confidentiality is really a challenge. The second consideration is that financial institutions are continuously moving part of their IT operation to public cloud environment. So as the market for cloud services is highly concentrated, there are warnings about increased homogeneity in the financial sector and single points of failure. So I think that the only solution to balance this is that policymakers and private sector need actively working together to mitigate cyber risk and their systemic implication. For example, many private and public sector organizations are strengthening their operational resilience, and many have engaged in, for example, war games or simulation of cyber attacks. So this exercise can help to identify vulnerability and enhance also to be more prepared to enhance the line of communication. And moreover, financial supervisors and overseers are leveraging national and international standards or guidance to promote cyber resilience. So the approach here has to be flexible, as also stressed by Arthur Lindo. So obviously relevant standards practice have been developed by CPMI, IOSCO, IAS, FSB, BCBS, among others. BIS is very active in supporting international cooperation in this area. So Pierre.
Thanks, Leroy.
Sure. Yeah, I'll speak from our experience at Moody's running the survey. As part of a survey process, you have the surveyor and you have the respondent. And so from our side, we've tried to be very careful in the types of questions that we ask, or be very intentional about the types of questions we ask. We try not to ask questions that would be considered very specific, that might raise flags for organizations filling it out, and that in many cases wouldn't offer that much insight. We're not asking specific questions about what exact technology they're implementing. That's not the most helpful, at least from our point of view. But we've even gone as far as, for one example is, instead of asking an organization, have you experienced a large cyber incident, we'll ask, have you reported a cyber incident to your board of directors, to customers, to regulators. So I think some intentionality in how you ask the question can be helpful. And then on the respondent side, we found that respondents all have a different risk tolerance in terms of what they're willing to disclose, what they consider to be sensitive information. So we've sent this survey to some organizations who fill it out, send it back, no problems, no questions. We have some people who say, well, I'll answer questions 1 through 20, but not questions 20 through 30. We've had organizations come and tell us, well, we have concerns about if we tell you this information, we might have to disclose it to some other people. So, all we can do as part of our job is to ask the questions, and our survey is voluntary. So, we ask the questions, we allow entities to participate to the extent that they feel comfortable, and then we take it from there.
Jonathan?
Yeah, it's interesting all the different answers here. When I think about how sitting from our place at RAND about data in this topic, I feel like we live in a world where this is perhaps me personally, not everybody at RAND, but I feel very data rich and very data poor. I think that there are times of which, if we're kind of in the national security space and I'm working with somebody in DoD, I might have access to a bit of data, but it's probably a type of data. And when it comes to the questions that we're all talking about, and where I'm really interested in sort of what the potential impacts of cyber risk, the potential economic impacts of cyber shocks could be, I find myself kind of data poor, and that's where part of it is not necessarily knowing how much the economic consequence, how much a given attack could cascade, but part of it's also not really knowing the. I would personally be very curious about the different softwares and sort of hardwares that companies are running, so that I could understand how much there are shared vulnerabilities out there. But there's some positive there of the data rich side, where where we're increasingly trying to use methods from data science really to estimate those things indirectly, and I think there's some promise for doing that.
Thanks. I'll ask one more question and then I'll turn to the Q&A to see what the audience is also thinking about. One of the things as an economist who's wondered about this topic in particular, and that has come up a little bit in these discussions and some of the analysis, is thinking about the kind of network and systemic impacts of potential cyber risk as opposed to the cyber risk that an individual institution might face. And even I was struck, Leroy, in your presentation somewhere like at Moody, so I was thinking, you would see it at the corporate level, but of course at the sovereign level, again, this sort of question about what's going to happen to the system and the risk in the system as opposed to an individual institution arises. When you think about the incentives that institutions have or even governments have to invest in cyber, do you think there are particular types of institutions or players that are under investing in this risk, where there's externalities to the system of their vulnerabilities, or that this is a case where in fact incentives are really well aligned, particularly in the financial services industry?
I'm happy to start because I've started the earlier question. So one particular thing that strikes me is the fact that when we think about the economies of scale with the use of third-party providers and even cybersecurity firms, at an individual firm level, it could be very true that the security provided by third parties and the resiliency provided by third parties is better than what the firm could do individually. Now, that doesn't mean that there aren't externalities. And I think that brings us to the question of trying to appreciate the system level value of the security when we take into account the commonalities. And so there, I don't think it's necessarily that firms are intentionally underinvesting. From a private perspective, their investments might be optimal, also considering the economies of scale. But one thing that is not fully internalized is kind of from a system perspective, whether that allocation is enough or appropriate, and whether they impose enough governance on their providers in order to ensure that they are protected from these risks more broadly.
Leonardo, you wanted to chime in, and then Jonathan, and then Leroy. We'll mix up the order slightly.
Okay. No, I just to follow up on what Michael said, I think that there is a general sense that there is an increasing need in investing in cybersecurity across the globe. So, for example, I was just thinking about a recent study by McAfee. There is an estimation that losses for cybercrime are estimated approximately to be $945 billion, while the global spending in cybersecurity is $145 billion. So overall, there is $1 trillion cost for the global economy. So in a recent research we have conducted here at the BIS, we have investigated the characteristic of IT security spending across sector with respect to a benchmark model. So we use data coming from Information Week 500 survey on firms mainly located in the US. And we have used a model, the Gordon Law model, to explain security investment at the firm level and to see which sector were deviating from this model. And in a nutshell, what we found is that the model predicts how much should be invested in IT securities for each given sector. And we observed that there is a high level of IT security investment in the financial sector, in manufacturing and utilities relative to other sectors. The results on the financial sector is not surprising because of the presence of regulation, but also the provision of certain products and utilities should be carefully protected for the benefit of society. The last point is about the importance to protect the sensitive information in the healthcare companies. And these we have seen during the COVID-19, they were highly sought after by criminals. This sector requires increasing attention because of the potential negative effect on individual privacy, and as we have seen during the recent pandemic.
Thanks, Jonathan.
Yeah, I think this is an interesting question, and I can't speak to specific areas of underinvestment, but I would say that in some of the work that I've been doing more recently in the security space on supply chain, cybersecurity of supply chains, we've seen that there is at least incentives for underinvestment across supply chains. So part of this is just due to the externalities that happen as those firms are interconnected, that one supplier's risk is another supplier's risk, which inherently leads to some incentives to underinvest. And I think that there are sectors that are better than others. Leonardo's papers have, I think, demonstrated that to me and convinced me that that at least finance has more incentives. And the other point that I think that's really important here was the one that Michael was talking about earlier, with the nature of risk when we use third-party vendors, and I think that one's is tricky because there's certainly trade-offs, and we can use FireEye as a really good example because it was in the news last week, and that you as a company you probably are doing your best by using them as a for your cybersecurity. You're doing your best by hosting things on AWS. And I think that generally speaking, that is decreasing your risk. However, there certainly is I think from a social perspective, there's a problem if everybody uses the same cybersecurity solution, that then the Russian government comes in and hacks so that they can break through security across many organizations all at the same time. So I think you have that trade-off of private versus public incentives.
Leroy, do you want to add, or do you not everyone has to comment on all the things, so.
Sure, I'll just say briefly that we ask questions about cybersecurity spend as part of our survey, and even with the numbers that we get back, it can be hard to interpret that or figure out if somebody's underinvesting, or if an organization is underinvesting. What has been very helpful is as organizations have become more used to sharing cyber data with us, is we've seen now cyber risk models as part of the packages that they bring to the rating agency that show how they're thinking about their spending on cyber risk, and gives a little bit more insight into how they're modeling the losses, potential losses associated with a cyber incidents. And I hope we see more of that going forward, and that has been a very useful tool.
Thanks. Turning in our last 10 minutes to some of the questions emerging in the Q&A in the chat. Jonathan, you started to respond to this a little bit. The question was asked about, responding to the news today's massive cyber attack, which I'll just interpret as, what you were just referring to, although you could also think about, Google was down for a little bit this morning. When you think about the work that each of you have been doing in your, in your respective areas, what perspective does that give you on the news that we're seeing today? Jonathan, I don't know if you want to start and add a little bit more, and then if anyone wants to chime in on the panel after that, just kind of give me a visual hand raise.
Yeah, I don't, I haven't read that much. I'm assuming the question was about Google's DDoS, which I didn't get enough time to read about before this, which is, but I do think it's interesting because there was a similar AWS incident 2 or 3 weeks ago. So I think not having read that much about it, I have, profound comments other than the FireEye one was really a mess and particularly concerning. And I think that, the one thing that you should read, that we all should read from this when it comes to FireEye to Google, is that you can have really secure places. You can still have a significant amount of investments in cybersecurity, and you still have these type of significant incidents. And so I think that's where Arthur was talking about it earlier. Resilience is really something that we should always be thinking about, because it's kind of not if you might have some type of outage from Google, or if all of your security protocols are disrupted after a FireEye. It's kind of when it happens and what you do next.
Leroy?
Yeah, we put out a report. I was going to speak in relation to the revelations about SolarWinds, software that's used by many agencies in the U.S. government, as well as in private sector. And we put out a report in, I think, July of this year, looking at third-party and vendor risk. There's been a number of high-profile attacks over the years that stem from a use of some software package or vendor solution, or it doesn't necessarily have to be specifically cyber, a vendor that has access maybe to the systems of an organization that's been used as the mechanism for some sort of cyber incident. And so we talked about our thinking about that, specifically that we think this is going to become more of an issue as organizations rely more on technology, and as they are outsourcing activities to these types of vendors. And we even put out a taxonomy of the sectors that we think would be most heavily affected by that, including manufacturing and autos, telecoms, media and technology, as being the most vulnerable to supply chain attacks. And I'm happy to share that report to be distributed as well.
Thanks. Michael?
So I think there's, I want to speak a little bit about FireEye, because one of the revelations, at least we've seen from public disclosure, is the fact that what they stated was the types of tools that that were leaked or lost as a process of the attack were not necessarily, they were proprietary, but incremental improvements from existing tools that already have been leaked before. And that kind of, I think, tells you only one side of the picture, because on the one side, yes, losing proprietary tools is very costly, as it can be used in order to orchestrate future attacks, but also just knowing the types of tools that are used to test existing firms is a vital source of information. And I think this kind of points to the need for a better understanding, and overall to inform the way in which we govern data, and also disclosed information. Knowing who the clienteles of these firms are, of a cybersecurity firm or consulting firm, getting access to their analysis of firms, and not just confidential, but public information on who the large firms are of a particular type of vendor. All of this information only improves the ability for a malicious attacker to improve and target precisely the weak points of our system. And I think that is something that I hope we can collectively improve on in terms of understanding.
Thanks. Moving to another question, and maybe a natural follow-on, Michael, to how you ended that. Do you think the policy response thus far has been sufficient at this point? You know, what more should the public sector be doing to convene, to collect information, to analyze that information? And as a corollary, you know, what should the private sector be doing? Waiting for you guys to hand raise. Oh, Michael, back to you. All right. I like how you're always willing to raise your hand first.
Let me just say a very quick thing. Anecdotally, firms invest in cyber risk after an attack. So that just shows that even though we have greater awareness, typically when can you get the energy and the motivation to invest and try to improve your preparation? It's only after you've kind of impressed upon the organization that it is important.
I think one inadequacy I would like to see more in the discussion is on deterrence. I think that there could be a lot more there, and I know that yeah, I don't want to talk too much about it, but I think that I know there could be that there has been calls from Congress and from other sort of public sector cybersecurity bodies on having a more well-articulated cyber deterrence plan from DoD and otherwise. And I think that kind of coordinating that with other, so of course there's what DoD can articulate, but there's also coordinated efforts from other agencies in government, and we'll point to some of the others in the room that I think could really help in articulating that cyber deterrence policy.
Leroy, why don't we make yours the last comment on this?
Okay. So I, as a Moody's employee, I can't make any recommendations or suggestions on what should happen, but I will give an anecdote, which is that we've seen ransomware be a particular scourge over the past couple of years. And there's been some movement by the US government to at least say they're going to enforce sanctions against ransomware payments to certain types of groups that are connected with designated entities. And that actually has caused some behavior shifts. So there was an incident a couple of weeks ago where a ransomware group said that they were going to be hosting data in Iran so that it couldn't be taken down by Western authorities. And then when it became clear that they might end up on a sanctions list, they backtracked and said, oh, we're not going to do that in Iran anymore. I spoke with an organization that suffered a ransomware incident, and the ransomware authors, when they found out that this entity was part of a healthcare organization, they said, oh, we don't, we're scared that we'll fall on the sanctions list, so here's your ransom key, get on with your business. And then there was another incident not too long ago where sanctions again scared a ransomware group into backing off. So I think that that could be interpreted as saying that could be a policy key for helping to deter these types of attacks going forward.
Great. Thank you so much for those thoughts, and to the panel more broadly. I think one of the things I found when talking about this issue and my role thinking about financial stability is at each stage of the game, there's really a hunger for knowledge. So in some cases, when you'll talk to the folks who are working closely on information security, them building a knowledge of what the business implications of attacks will be is a real challenge to kind of connect the tech angle to the business angle. And then in some of the work we've seen here, connecting a single institution to the stability of the system, because that of course has repercussions back to each individual institution, is also really critical knowledge building. So thank you so much for your participation in the panel and the work you're doing on this really important topic. This conference is going to convene again tomorrow with some really interesting panels. So I hope to see you all virtually again tomorrow as well. Thanks very much.